Hello and welcome to another video on my YouTube channel. My name is Joris, and in this final part of how to evaluate a stock, I'm going to give an example. But first, of course, I need to go over the previous videos a bit so that you can follow along this one. So, as you know, saving is hard. Investing with the investing apps right now is pretty easy. So with one click of a button you can buy a stock, but picking the right stock is hard. So if you pick the wrong stock, you will lose money for sure. So you need to know how to pick the right one. And then you should always remember the first rule of the video that I made about the rules for dividend investing, and that is that you should go for quality companies before the dividend yield. So don't chase dividend yields, but chase quality companies. And in order to do that, you should follow the rules of the sadly passed away Charlie Munger, and that is you need to understand the company, you need to know whether or not a company has a durable advantage. So if they have a moat around their business model, you have to like, trust, or believe the management. But as I said earlier, that's a really difficult thing to do for us mere small investors. And then you have to like the price. And to know whether or not you like the price, you have to do the evaluation of the stock, of course, and include a margin of safety. And then I mentioned that evaluating stocks does matter because, okay, you can say that when you pick 10 stocks and one is a winner and you lost money with the other 9, you're going to perform okay, but your choices were actually based on luck. So you have the book of Burton G. Malkiel that was written in 1973, where he says that we are just dart throwing monkeys. Even Warren Buffett is a dart throwing monkey, even though he's performing exceptionally well. But for me, I think not selling that one stock, even though it can drop, it could have dropped with 30%, but you hold on to it, and you could have sold those other 9 stocks before they hit zero. So especially in the selling, evaluating stocks matters for me. And how you should do it for stocks that make a profit, I explained in the previous videos, and I will give an example in this video. So you should always also be aware that the formulas that I'm using are already a simplification of other formulas that other used in their books, and I think they already made a simplification as well. And especially the formula of Graham, you should certainly be aware of that, is that in the original book there was already a footnote attached to that formula. So this slide is going to be overcrowded, I know it, but you can pause the video and take a screenshot from it and take away just the most important things. But you know, I started with Peter Lynch and his formula with future growth of the earnings per share plus the dividend yield divided by the PE ratio. And for me, I could write it easier as the future PE divided by the current PE. And then with this table next to it to see whether or not you can buy it. So when it's above 1, it's fairly valued. Above 1.25, it's 20% undervalued with a margin of safety of 20% then, and very undervalued with a margin of safety of 40% with a value of 1.66. And then we have the old formula of Benjamin Graham with the earnings per share times 8.5 plus 2 times G times 4.4 divided by Y. But you could write it easier, just scrap this one because we are long-term times investors, so we can already eliminate those. And then you have the value of the stock with the earnings per share times, excuse me, 8.5 plus 2 times G. And the future PE you can then write as 8.5 plus 2 times G. And then the new formula of Benjamin Graham, where those factors are different, so 8.5 becomes 7 and the 2 becomes a 1. That you can write as the value of the stock as EPS times 7 plus 1 times G. And the future PE you can then write as 7 plus 1 times G. But as I said, margin of safety, really important with these valuations. You can already take a margin of safety for the estimate of the growth rate, but certainly use a margin of safety related to the riskiness of the business you want to invest in. And the simplifications are from me for doing my screening, and I'm already doing it for almost 30 years. It's 29 years right now, so by now you should know how old I am. But that's beside the question, of course, beside the point. And I want to know my window. So my window is between the old valuation of Graham and the new valuation of Graham, and I aim to have my valuation. So with my own PE table that I gave in the previous video. And then, as I mentioned in one of the first videos of this series, but which earnings per share are you going to take? The trailing 12 months EPS, or are you going to calculate with the earnings per share that is predicted for next year? Because when the earnings calls are getting closer, are you already going to calculate with what you think is going to be the EPS? Because on that point, of course, a lot of people are still calculating with the old value. And when you know the new value is going to be a lot higher, you know that the stock on that point is actually undervalued. So it's not financial advice, of course, but I want to go over an example. So, and I'm taking ABB. So it's one of the 20 stocks in the Swiss SMI. It's just the first stock of the Swiss SMI. So I said, okay, I'm going to take the first one because it's an easy pick, the first one in the list of 20. It's Asia Brown Bovary. If you didn't know where ABB stands for, now you know. And it's a holding that consists of 4 divisions. So you have electrification products, robotics and motion, industrial automation, and power grids. And as I said, it's just an example, not investment advice. So it's just so you know how you can easily apply the numbers and the formulas that I gave on the previous slide, so that you can go ahead and do it yourself and make up your own mind, because doing your own analysis is always key. So it's already half a year ago that I mentioned all 20 stocks of the SMI, and this was the slide back then. So it was on the 24th of November of 2023, and then the price of ABB was 34.13 Swiss francs. The dividend that it paid out in 2023 was 0.84. The dividend yield was then 2.46%. The earnings per share were 1.20 Swiss francs. The payout ratio, with 0.84% being paid out from the earnings per share, was 70%. And the PE ratio was 28.4 on that time. So they had already a run of 18 years of continuous dividends, with 17 years of growing dividend yield, growing dividend, and there was a growth of 2.32% on average in the last 5 years. So this was the graph of their dividends. There was a dip here, but you should add this little peak to here, and then it was more or less the same as the previous year, even a bit higher. I think it was 0.7 in that year when you counted them together. But it was a normal dividend and a special dividend. So a special dividend where you didn't have to pay the total amount of taxes on. So that's always nice. And then for 2024, so the numbers are going to change. So now it's 47.41. So it rolls quite a bit in the past 6 months. So it's the price of last week on Friday, because I started making these videos the presentation last Friday, but it was quite busy on my work, so I didn't have time until today to start recording the videos. So excuse me for that I didn't put out a video on Monday. It was the plan, but I didn't have time at all. So the dividend went up from 0.84 to 0.87. The dividend yield dropped because when the price goes up and the dividend goes up only a little bit, the dividend yield goes down by a lot, of course. So now 1.84%. The earnings per share is 2.01, and the payout ratio dropped from 70 to 43.3%. So that's what you like to see, of course. The earnings per share going up, the dividend going up, and the payout ratio going down. And the PE ratio went down as well from 28 down to 23.6. So they are on a roll. They added another year of continuous dividends, and now they have 18 years of consecutive growth of their dividends. So 7 years to go, and they are a dividend aristocrat on the norms of America. So I think it's 15 years in Europe to be a dividend aristocrat. So in Europe they already have the title, but in America they would say no. They are just they are just trying to become one. And the average growth of the dividend the last 5 years went up a bit from 2.32% up to 2.50%. So that's the new graph. So now we are even closer to 0.90 Swiss francs every year. And that's also another thing. They still pay annually. They should start paying quarterly. Just pay 0.22 next year every quarter, and everybody is happy. So let's see what this means for ABB. So the growth rate estimate, according to me, was 6.10% in 2023. In 2024, now I think they are going to grow a little bit faster, 6.60%. As you remember from the growth rate on Yahoo Finance, it was for 2023, that was 6.58%. But I took it lower with 6.10, and this year I went up a bit to 6.60. And then you can calculate the PE value. So for 2023, the new Graham formula is 13.1. So my formula, as long as it's lower than 10, it's the same. So 13.1, 16.6, 13.1, 16.6. And the old Graham future PE value that I always calculate for 2023 was 20.7, and for 2024 it's 21.7. So if we then look at the Peter Lynch calculations for 2023 with a PE value of 28.4, then for the new Graham and my future PE value, that was certainly lower than 1, this one as well. And for the old Graham future PE value, here you have 20.7 divided by 28.4, so you have a value of 0.73, so it's lower than 1, so it's overvalued. And for this, at this moment, it's 21.7 divided by 23.6. It went up already because it's now trading at 48.80, not 47 point a bit anymore. So this PE value is now 24, I think. So we were at 0.92, but now we are, I think, already on 0.90 or something like that. But it's getting closer to 1. And yeah, if you then calculate the future valuation, so the price that you want to pay right now for the stock, for having profit in the future, then last year with the old formula of Graham, you would have had 24.84 versus the price that it was on the stock market back then, 34.13. So there was a discrepancy of almost 10 Swiss francs between the price you wanted to pay for the stock and the price it was on the stock market. And right now it's 43.62 for the old formula of Graham. And as I said, yeah, it was 47.40, but now it's 48.8. So now there is a discrepancy of 5 Swiss francs between the current price on the stock market and the price you want to pay. So that's also without a margin of safety. So also keep that in the back of your head. For a firm like ABB, I think a margin of safety of 10% is more than enough. It's a stable company. They are stable in producing their earnings. They are stable in distributing their dividends as well. So it's a pretty stable company. Then making the calculations with a margin of safety of 10% is certainly okay for ABB. So, and also take into the back of your head that in the valuation of Graham, he has the extra thing of the 4.4 divided by the Y, so the AAA bond average bond rating, and a 10% margin of safety that you should calculate with. So this factor, I don't calculate it because for me, I'm a long-term investor. I'm certainly, when I buy a stock, I'm not planning on selling it the first 10 years that I hold it. So that's why I think this factor you can drop it. So ABB is overvalued, but a half year ago it was more overvalued than now. So 10 Swiss francs compared to 5 Swiss francs right now. And last year you could actually buy it cheaper. So last year you could buy it at 34.13 on the stock market. And now it is trading at 48.8. So although here it said you could only buy at 24.84 because you are calculating, of course, with the earnings per share of the year before, and you should actually be calculating maybe with this number. And if you would have done that 2 times 20.7, you would have had a valuation of 41.4. So then you could say, okay, it's undervalued. So the earnings per share is also really important. So it's not only about finding the growth rate and thereby the future PE value that is depending on the future growth rate, but also which earnings per share you use to do your calculations with. So yeah, trading 12 months, every quarter you need to do the calculations. Are you going to use the future EPS completely? Are you going to estimate them yourself? That's why you should know your company and you should use a margin of safety. So certainly do not try to catch a falling knife. So for instance, I can again name Credit Suisse. They were dropping and dropping and dropping. We as small investors, we can't talk with the management. It's not like they are standing on the side of the street and you can go up to them and say, hey, why are you doing that, and what is going on with that scandal, and is your opinion on that? So you need to read up on it, and when a stock is dropping and you see that the valuation is actually good for Credit Suisse because it was trading at book to value. The book value was around 11 Swiss francs, 12 Swiss francs, and it was trading at around 3-4 Swiss francs at some time. Also, when they did how do you say it, the increase of capital, they were trading actually quite at a good valuation, but yeah, the management and with all the scandals. So do you want to actually invest in a firm like that? Yes or no? And if you have a lot of money, you can put some of that money into Credit Suisse and take a gamble. But when you don't have a lot of money, because saving is hard, then you shouldn't put your money into Credit Suisse because the risk isn't worth risking your money. So yeah, rich people, they can take the risk because they can diversify into 100 stocks, and if then Credit Suisse comes crashing down, they still have the other 99 stocks that can make up for the loss that they made with Credit Suisse. But when you can only buy 2-3 stocks, then don't chase just the stocks that are seemed that are priced really cheaply, but that you don't know whether or not the management is doing the right thing. So do not try to catch falling knives. Another example is ISM Osram here in Switzerland. Okay, it's a firm from Austria, but it's trading on the SIX stock exchange. That's also a falling knife. They they aren't sold yet, or if they are going to be sold, that's another thing, of course. But yeah, it's the same thing. Credit Suisse, ISM Osram, they are falling knives. Stay away from them. Even when they go up suddenly 30-40% and they are still cheaply priced, don't start buying them. It's a dangerous trap for small investors. And with that being said, I thank you for watching this series. I hope you learned something. If you have remarks, you can always write them down in the comments down below. But please subscribe to my YouTube channel. It would help out the channel enormously. Hitting that like button as well. And see you on the next video on my YouTube channel. Bye.